Welcome to PhillipCapital's Market Watch. My name is Mavis. I am a CFD Dealer from Phillip Securities. Today, I'll be sharing insights into the low interest rate environment. According to economists and market analysts, 2026 is expected to see lower interest rates, as central banks, particularly the Federal Reserve, are likely to continue easing monetary policy. This shift reflects a move away from restrictive rates level towards a more neutral stance, driven by cooling inflation, a softening labour market, and the need to support economic growth. Let us take a closer look at the factors contributing to the low interest rate environment and how it affects investors. First and foremost, the low interest rate environment is largely a result of easing inflationary pressure. Recent data shows that inflation slowed more than expected in November 2025. As illustrated on the chart, the Consumer Price Index is slowing to 2.7% from 3% in September 2025, which is the lowest annual rate since March 2021, before the historic bout of high inflation. With inflation moderating and becoming more manageable, maintaining high interest rates is no longer necessary. As a result, central banks are shifting towards a less restrictive policy stance, gradually moving towards neutral rates to balance price stability with economic growth. In addition, signs of a softening labour market have emerged. Rising unemployment rates and weaker hiring data suggest a cooling job market, prompting the Fed to consider further rate cuts to avoid a sharper economic slowdown. Labour displacement caused by increased automation and the adoption of artificial intelligence has also contributed to job losses across certain sectors, further weighing on employment conditions. Based on the chart, we can see that the monthly job creation in the US continues to trend lower. According to Justin Ladner, senior labour economist at SHRM, the outlook is neither a booming nor a collapsing labour market. Instead, it reflects a period of stagnation characterized by slow hiring, low resignation rates, and overall subdued labour market activity. This frozen labour market environment reinforces expectation that interest rates will remain lower for longer, as policymakers seek to support employment and economic stability. Moreover, forecasts for a slight slowdown in GDP growth also further encourage the central banks to lower interest rates, making borrowing cheaper and stimulating activities. Many economists and institutions forecast a global and regional GDP slowdown in 2026. Following a stronger 2025, primarily due to lingering effects of trade tensions like potential US tariffs, global economic rebalancing, and geopolitical uncertainties. As shown in the chart, global GDP growth is projected to decelerate in 2026, reinforcing the case for accommodative monetary policy. For savers, traditional instruments such as saving accounts and fixed deposits are likely to continue offering relatively low returns. After accounting for inflation, real returns may remain modest, making it more challenging to preserve and grow purchasing power over time. For investors, however, a low interest rate environment can present opportunities. Lower borrowing costs support business expansion, encourage investment, and help sustain economic growth. As a result, equities and income-generating assets may remain attractive alternatives to cash holdings. In a low interest rate environment, dividend-paying stocks, REITs, and income-focused funds may appeal to investors seeking regular income beyond traditional deposits. At the same time, quality growth companies can benefit from lower financing costs, supporting long-term capital appreciation. REITs, in particular, are highly sensitive to interest rates as they rely on borrowing to acquire and manage properties. Lower interest rates help reduce financing and refinancing costs, while compressing yields can support higher property valuations. This combination may enhance both income stability and capital value over time. That's all for this episode of PhillipCapital's Market Watch. Remember to like, share, and subscribe, and follow us on our social media platforms. Thank you so much, and see you next time.